Goldman Sachs predicts that the S&P 500 could deliver annualized total returns of just 3% over the next decade. That's a stark contrast to the 13% average return we saw in the last decade, and well below the long-term average of 11%. So, why the gloomy outlook? Goldman Sachs strategists point to a few key factors. First, they expect investors to diversify into other asset classes, reducing the dominance of U.S. stocks. The remarkable performance of the S&P 500 over the past decade was fueled by low interest rates and quantitative easing, conditions that are unlikely to continue. Another major concern is the increasing concentration of market gains in just a handful of mega-cap tech companies, often called the Magnificent Seven. While these companies have seen impressive growth, sustaining such high levels of growth and profit margins over an extended period is historically challenging. Even if these tech giants keep thriving, the overall impact on the S&P 500's performance could still result in below-average returns, estimated at around 7%. This highlights the potential vulnerability of the index to the performance of a limited number of companies. Interestingly, however, not everyone shares this bearish outlook. Ken Mahoney, CEO of Mahoney Asset Management, for instance, remains optimistic. He points to the ongoing AI revolution and strong demand for technology, especially in sectors like semiconductors, as signs of continued growth potential. According to Mahoney, trying to time the market perfectly is extremely challenging. He believes that focusing solely on predicting the next downturn could lead investors to miss out on potential gains. So, what could this mean for income investors? Well, outside of the share prices, if we see a long stretch of a bear market, we may see some distributions start to fall in certain funds or sectors. So, what should investors do? The truth is, market predictions are inherently uncertain and difficult to predict. While Goldman Sachs and JP Morgan present a relatively bearish outlook, it's essential to consider a wide range of perspectives. Conduct thorough research and make informed decisions that align with your individual risk tolerance and long-term goals. Remember, investing is a marathon, not a sprint. Stay informed and stay invested. That's all for today. If you found this video helpful, don't forget to please like and subscribe.